Hello, my name is Lucia. I would like to continue to talk about how to compute a corporation's earnings and profits and shareholders' dividend income, and I will try to explain the taxation and stock distributions. Computing earnings and profits. The overview of distributions. Dividend distributions are included in the shareholders' gross income. Non-dividend distributions are a return of capital, reduced shareholders' tax basis in the corporation stock. Non-dividend distributions in excess of the shareholder stock tax basis constitute a gain from sale or exchange of the stock. Negative current earning and profit, negative accumulated earning and profit. None of the distributions is treated as a dividend. Distributions will be return of capital to extent of stock basis. Any distributions in excess of stock basis is treated as capital gain. Here's an example took from our book. I'll go further. Despite the general rule, stock dividend can be taxable if shareholders have an option to receive cash or other property instead of stock. Some shareholders receive cash or other property and others receive stock and increase their proportionate ownership. Some shareholders receive preferred stock while others receive common stock. Shareholders receive distributions with respect to preferred stock, or shareholders receive distributions of convertible preferred stock. Distributions of non-cash property to shareholders. Non-cash distributions can be more complex for two reasons. Any liability attached to the property affects the amount distributed. Any difference between the value and the tax basis of the property affect the calculation of earning and profit. Tax consequences to a corporation paying non-cash property as a dividend. The corporation recognizes gain but not losses on the distributions of non-cash property as a dividend. Gain is recognized to extent of fair market value in excess of tax basis in the property. Liabilities, if the property fair market value is less than liabilities assumed by the shareholder, the fair market value is deemed to be the liability. Losses not recognized. Example: shareholder receives a property distribution from Sony Corporation with a fair value of $200. Share assume a $100 mortgage attached to the property. Sony's basis is in the property distributed is $100. Sony Corporation reports a gain of $100 on the distributions. Another example: shareholder receives a property distributions from Sony Corporation with a fair value of $200. Share assume a $300 mortgage attached to the property. Sony's basis in the property distributed is $100. Sony Corporation reports a gain of $200 on the distributions. The property is deemed to be the amount of the liability assumed because it exceeds the property's fair market value. Property dividends effects. Effects on shareholder: reduce amount distributed by liability assumed by shareholder. Basis of distributed property equals fair market value. Effect on corporation. Corporation is treated as if it sold the property for fair market value. Corporation recognizes gain but not losses. If distributed property is subject to a liability in excess of basis, fair market value is treated as not being less than the amount of the liability. Effect on corporations' earnings and profits. Increases earnings and profits for excess of fair market value over basis of property distributed, gain recognized. This earnings and profits by fair market value of property distributed, or basis if greater, less liabilities on their property. Distributions of cash or property cannot generate or add to a deficit in earnings and profits. Deficits in earnings and profits can arise only through corporation law. Non-cash property distribution affect earnings and profits. Template how to compute the effects of distribution on earnings and profits. Current earning profits computed before any distribution but recognized on distributions of appreciated property minus money distributed minus earning profits adjusted basis of unappreciated property distributed minus fair market value of appreciated property distributed plus liability assumed by the shareholders minus tax on gain recognized equals undistributed current earning profits added to accumulated earning profits from prior years. Current versus accumulated earning and profits. Current earning and profits taxable income as adjusted. Accumulated earning and profits. Total of all prior years. Current earning and profits as of first day of tax year reduced by distributions from earning and profits. Distinction between current and accumulated earning and profits is important. Taxability of corporation distributions depends on how current and accumulated earning and profits are allocated to each distributions made during the year. Allocated earning and profits to distributions. If positive balance in both current and accumulated earning and profits, distributions are deemed made first from current earning and profits, then accumulated earning and profits. If distribution exceeds current earning and profits, must allocate current and accumulated earning and profits to each distribution. Allocate earning and profits pro rata to each distributions. Apply accumulated earning and profits in chronological order. If current earning and profits is positive and accumulated earning and profit has deficit, accumulated earning and profit is not netted against current earning and profits. Distribution is deemed to be taxable dividend to extent of positive current earning and profit balance. If accumulated earning and profit is positive and current earning profit is a deficit, net both a date of distributions can be if balance is zero or in deficit. Distribution is a return of capital. If balance is positive, distribution is a dividend to the extent of the balance. Any current earning and profit is allocated ratably during the year unless the parties can show otherwise. Here is an example how to see the accumulated earning and profits beginning of the year, current earning and profit, and the dividend. Stock dividends. Sometimes instead of cash or property, a corporation may distribute stock dividends, which represent the capital of retained earnings by increasing the number of outstanding shares. A stock dividend is a proportional distribution of additional stock to its shareholders. Because there is no distribution of cash or property, the firm's assets and liabilities, and therefore the stockholders' equity are not changed. Excluded from income if pro rata distribution of stock or stock rights paid or common stock. 5 exceptions to non-taxable treatment deal with various disproportionate distribution situation. Effect on earning and profits. If non-taxable earning and profit is not reduced, If taxable, treat as any other taxable property distribution. Basis of stock received. If non-taxable, if shares received are identical to share previously owned, basis equal cost of old share divided by total number of shares. If shares received are not identical, allocate basis of old stock between old and new shares basis on relative fair market value. Holding prior includes holding prior of formerly held stock. If taxable basis of new shares received in fair market value, holding prior starts on date of receipt. Thank you for watching. Thank you for listening. Sorry for my voice. I hope my colleagues will explain better. Thank you.